Good morning and welcome to the Killik & Co market update. It's lovely to be bringing this update to you from our offices for the first time since March 2020. And this is because for Killik and for a lot of other firms and of course schools, this week marks the return to almost normality. It's been the week of the big return. And this has been something that TfL have confirmed. So taking Tuesday, the morning rush hour on Tuesday, they've reported that tube journeys have gone up by some 33% compared to the week before, and bus journeys in that morning rush hour were up by 71%. Now, while at Killik and other firms, a hybrid approach is being adopted. So under this, staff are mixing time between the office and between their homes. But it's still been really wonderful to catch up with people, to see people face to face. And also we've been pleased to receive many more clients into our offices over the last week. And of course, this is good news for London and cities and towns more generally. With the return to work, we're seeing increased footfall, and that's beneficial to restaurants, to shops, to cafes and other ancillary businesses. Now, it's too early to tell exactly how this will play out and who the winners will be, but certainly one winner at the moment have been sellers of business clothing. And for example, TM Lewin came out and explained that they'd seen their sales numbers shoot up, with their sales of suits rising by some 225%, and their sales of shirts up by 200%. We've seen nervousness in markets this week, and this has been partly attributable to concerns that the European Central Bank, the ECB, will be reining in the amount of stimulus that they've been giving markets. Now, back in March 2020, the ECB, the Bank of England, and the US Federal Reserve all acted swiftly to shore up markets, and they did this by buying government bonds, by buying corporate bonds, in higher volumes than previously. And this was very successful. It brought down the costs of borrowing, it improved confidence, and ultimately it led to higher equity valuations. Now, markets which have become rather like toddlers who are used to having more sweets have now been fretting that with the improvement in the economy, this stimulus will be reduced. Within the ECB, there has been internal debate between, on the one hand, the hawks on the rate-setting committee, notably the German and the Austrian representatives, who have been concerned that the level of stimulus, which is currently 80 billion euros a month, can't be afforded, and so they've been arguing for a reduction in the level of stimulus. On the other hand, have been the doves, for example, the Italian representative, who are arguing that the level of support should be maintained. Now, in the event yesterday, when the ECB released their statement, they explained that Eurozone growth had been higher than expected, and also that the Eurozone had been relatively resilient to the Delta variant following a successful vaccination program during the course of the summer. And as such, they were going to be reducing the level of support, but they sought to strike a compromise and only take very small steps towards this. So they said that they would be reducing the asset purchases, but only moderately, and they would also be very prepared to increase asset purchases if the outlook worsened. Now, markets which were pretty weak in the run-up to the announcement, they didn't move very much on the statement, which suggests that the compromise which was delivered had been largely priced in. In terms of results, last week was a fairly quiet week, although one company we did hear from was Danaher, who held their first investor day since 2018 yesterday. Now, Danaher is a US conglomerate, but it's got a real focus on healthcare. And healthcare is an area that's of significant interest to us as an area to invest in. So this is because the healthcare market is growing. And it's growing because in Europe, in the US and Japan, we've got an aging population. And at the same time, in Asia and across emerging markets, there is a growing middle class. So there's more money, in other words, to spend on healthcare. Now, the performance that Danaher have produced in recent years has been fantastic, and this can be seen by reference to the company's share price. So this performance has been in part down to the fact that they have carried out a series of very well-planned acquisitions. So they've been buying businesses with a very high and fast growth profile, and they've been absorbing these businesses into the conglomerate, reducing costs, and then with the money saved, they've been reinvesting and producing yet more profitability. Another area of real interest to us is Danaher's life sciences business, and this accounts for about 50% of revenues, but it's growing very quickly, and revenues in recent years have been growing at about 20% per annum. And actually, in part, this has been down to COVID. So Danaher have been very involved in the research and development behind vaccinations for COVID. When management provided the update yesterday, they explained that once again they were going to be increasing their forecast for organic revenue growth, and they were talking about increasing this by at least 1% to somewhere between 6 and 7% per annum. Finally, looking at next week, we're expecting another fairly quiet week in terms of results. Of the companies that we follow, Ocado are going to be reporting on Tuesday, and we're going to be hearing from Ashted on Thursday. That's it from me. I hope you have a very good weekend.